And good afternoon to all of our friends and clients in the East, and good morning to all of our friends and clients in the West. This is Larry Shavaro, Executive Vice President at First Associates, and I'd like to welcome you to our 6th webinar in our successful webinar series. Today we have David Johnson, the CEO of First Associates, who's going to share some thoughts around FinTech loan servicing. Before we start, a couple quick announcements. All of the previous webinars are online at the First Associates website at www.onestassociates.com. During the webinar, please send in your questions. We typically get a dozen or two questions. We'll try to answer a few, and the ones that we do not answer we will send back through an email back out to the group. And there's a survey at the end, and so if you can take a minute or two and complete our survey, it helps in regards to content for future webinars. The agenda this morning and this afternoon here will be 8 to 10 minutes of information around FinTech servicing, followed by a quick Q&A. And again, after the webinar, you will receive an email with a link to the recording as well. A couple quick announcements. Rose, next slide please. Some upcoming events. Many events going on in the 3rd and 4th quarter. We have quite a few events in New York, which is the iGlobal Specialty Finance Summit, the AltFi, which is the UK group coming back into New York for their 4th event, ABS East out in Miami. Our Southern California Consumer Finance Professionals Meetup is back on September 21st in Carlsbad. If you're in Southern California, it's a great event. We've been getting close to 100 people for a great evening of some content and networking. Our next webinar will be on contract verifications, which is an important topic for the marketplace lending space, and that will be on September 21st. And the California Financial Association's annual conference out in Ojai, California, somewhere around Malibu, on September 22nd. And then some really good events. The American Banker, they have their, I believe, their 3rd annual event in New York in late September, followed by a fabulous event put on by the Online Lenders Association called Lend 360 in Chicago, Lend It Europe, and the Commercial Finance Association's annual event. First Associates will be attending and speaking at all of these events, so please come find us, and love to share that with you. Rose, next slide please. For those that are new on our webinar today, a little bit about First Associates. We are the largest third-party marketplace lending servicer in the U.S. We service approximately 75% of the players in the market. Many of the investment banks and hedge funds and credit funds that are purchasing or financing leverage on these facilities are our clients as well. We recently celebrated our 30th anniversary, and the Mayor of San Diego proclaimed March 2nd as First Associates Day. We have 2 facilities in San Diego and in Baja, and besides loan and lease servicing, we provide backup servicing, custodial services, contract verification, and paying agent services across many different spectrums. We service approximately 15 different assets, all consumer assets, auto, RV, marine, structured settlements, tax liens, unsecured product, marketplace lending, small business, merchant cash advance, no credit card today, and no mortgage. Next slide, please. Thank you for our array of clients. We value our relationship and our friendship with many of our clients that are listed here today, and this is only a handful. Next slide, please. And Rose, it's my pleasure to present David Johnson, the CEO of First Associates, who's going to share some thoughts around FinTech servicing. David, welcome today.
Thanks, Larry. Hi, everyone. Appreciate everybody making time for this webinar. I know everyone has a busy schedule. I think it's interesting business that we're in, FinTech and servicing as well. People think about FinTech as a very rapidly moving industry with lots going on, but people often don't think of servicing as a rapidly moving industry. But there is actually a quiet revolution, well, in some cases not so quiet, revolution underway. Just as the origination and funding pieces of lending have changed dramatically, and we've seen that over the last 5 to 6 years, there's been a complete upheaval in those marketplaces. The servicing industry is going through that same change. It's a little more under the covers. It's a B2B business, so it's not quite as visible, but it's clearly there. Most of the models that you see in servicing today are legacy of the earlier iterations of consumer finance. You have large single asset line servicers. Most of the mortgage servicers would fall into this category, or most of the student loan servicers as well. Or you see somewhat hastily assembled value chain constructs designed for startups where you often have first-party collectors as part of the core process, and there's not really an established relationship-building activity there, but it has the great advantage of being highly scalable and very cheap to put on at the beginning. So today I'll talk about what some of the key topics in loan servicing are. And I will try and not make this something like, oh yeah, you should call people and ask them to pay type of discussion, but a discussion of the larger issues within servicing and touching on some of the issues within FinTech as well. So talking about what's key for loan servicing and what you really need to think about for a loan servicer or for your in-house loan servicing if you have that. First off is information management. From a practical point of view, I can say that having been in this business now for quite some time, we have seen time and time again where the quality of information that's housed at the legacy servicers is frankly just terrible. And often we see this at some of the in-house servicers as well that we take over or work with. That quality of information, just the really basic meaning of that word, that the information is accurate, that the information is up to date. We know where the consumer lives. We know what the consumer's phone number is. We know what the actual amount owed is, and we know all the specific terms of the agreement. It seems like a small thing, but it's the base on which everything else is built. And making sure that that information is accurate is a big deal. It's a full-time job for the company, and it really leads to much better servicing results. In pursuit of that, any given loan servicing operation that is actually collecting critical information and gathering it up and collating it and using will produce terabytes of information. You'll have massive information overload. It is in origination, there's quite a bit of information that gets traded around, that gets housed, but it's static. In servicing, it's almost like you're originating every month or every week or every day because you're having ongoing interactions with customers, and this may be over a 3, 5, or even a 30-year period. So the amount of information that you're gathering up is quite large. That information needs to be, 1, highly secure. It needs to be, 2, highly regulated. Well, it is highly regulated, so you need to be very compliant around this. And it needs to be housed in some architecture that is flexible and scalable. So in the old world, what you would find with the legacy servicers is proprietary systems first and foremost. It's kind of the best technology that 1992 had to offer. And it's usually a case of you broke it, you bought it. They bought some system or they built some system in the 90s, and then they kept modding that system. And if it was an out-of-house system, they would bring it in-house because at some point they made so many mods that they couldn't just install the next rev. And then the inevitable takes over that we've all seen, which is that the number of maintenance FTEs far outweighs the number of modification FTEs, and you wind up in a situation where you're suddenly static. You're trapped by the economics of a snowballing IT platform. That's not a good loan servicing platform. It traps you in yesterday's world. You want to have a platform which is preferably SaaS, must be in the cloud to handle all this data. We still see firms with in-house server farms or data centers, which, for all the reasons that you would think is a bad idea in any industry is a bad idea in this industry as well. So the critical things about information management are accurate information and systems and processes which make sure that that happens, that it be cloud-based so that you can expand, it's flexible, even things like if you need to house your data in a certain jurisdiction because of the regulatory constraints, you can imagine how much better that is in a cloud environment than in an in-house data center environment. Multiple redundant backups on top of the platform, and the ability to integrate with a large number of other information sources, and I've listed a few on the right, whether those information sources be consumers, just a conversation with a consumer, or some information they give you, an origination platform so you can take in loans, or whether it be, for instance, collateral management where you're working with firms to repo vehicles or other vendors that you might have. That information management piece, which sounds quite mundane, is not to be underestimated. Next slide, please. The next piece is about consumer communication. And this is the piece that I think most people think about when they think about loan servicing. It's a bunch of people on phones calling people. Of course, the truth is more complicated than that. For a consumer communication platform to exist, first you have to think about be able to record, be able to analyze, and be able to act on the consumer's preferences. So what channel would the consumer like to communicate on? For FinTech, the answer is usually pretty obvious. You think about the channel capability that you need to have, and I've listed a few on the right, where you communicate with the consumer through the channel of their choice is usually one of these. And of course, FinTech consumers who have engaged with this relationship at the outset through an electronic means across the internet usually, they prefer electronic means. There's definitely been an explosion of channel capability. It's basically the cable TV of the loan servicing world, is that as a consumer, you can communicate with your loan servicer, at least with First Associates, across many different channels, and the consumer can choose which channel. And there's a huge advantage there where if you're communicating with the consumer across the channel of his preference, then you're much more likely to actually communicate with that consumer. Timing is self-explanatory. You want to make sure you're calling it or texting or emailing at the time of day the consumer would choose, and the content also drives that. One of the big trends that's happening, one of the macro trends that's happening here is essentially the death of voice communication. And obviously it's still the mainstay for servicing, but over time we see voice communication going the same way as tellers at the local bank. People simply prefer to deal with an ATM, and they simply prefer to deal with automated means for servicers as well, particularly in the FinTech world. Compliance on consumer communication is obviously a big topic. On the federal side, you've got a large number of developing issues coming to the forefront. You've got a large number of agencies that are in play, issues that you've all seen Madden Midland and what that means on the origination side. On the servicing side, there are kind of equivalents that are of equivalent scale. For instance, the U.S. Treasury's push to start treating all small business customers as if they were consumers. And that brings an entire raft of additional compliance to the small business arena. There's also tightening regulations about the where, when, and how you can contact consumers. For instance, texting is regulated by the FCC, which you wouldn't normally think of as being involved in finance, but in the servicing world, we'll talk about compliance, but compliance is much more nuanced. There are state-by-state issues to be dealt with. For instance, in the state of Massachusetts, you can text or dial twice per week, and that's it. Then that's all. And obviously, all the states have their own flavor of whatever these things might be, but the state-by-state quilt of consumer communication legal requirements is quite complicated. And that goes for jurisdictions as well, whether it be New York or Chicago. Many jurisdictions have their own rules. We also see state-by-state compliance requirements are moving up steadily in that model where companies are using first-party collectors. We often see compliance issues there, and frankly, we just don't see first-party collectors with the appropriate portfolio license, obviously. I'll skip over the part about effectiveness. I think people mostly know about right party contacts, portfolio performance. If you're not talking to the right person, then there's no point in talking. And that leads to portfolio performance. Next slide, please. Talk a little bit about scalability. There's a couple points on scalability that I'll go to. In FinTech, the ability to grow large rapidly is key. To go from 0 to 60 immediately is a lot of what the industry has been about. And we have clients who go from 0 to 10,000 loans a month in the space of a month. And that denotes a certain set of skills. Yes, it's messy sometimes. It's a startup environment often in these types of things. In that small kind of 0 to 60, you want to make sure that you're able to handle multiple iterations of a business model, of the origination platform, of the products on offer. All these things are up for change. So that flexibility is key to having a successful servicing portfolio. At size, once you get to a larger size, other issues come to the forefront. Things like the data management issues. How are you going to house those terabytes of data? Building out additional capabilities. Compliance is a huge one because as you get larger, your compliance game needs to get up to the next level extremely rapidly. And then personnel, if you are stuck in a labor pool, which is non-advantageous, like, say, San Francisco or a small one like Rapid City, that's not a good situation. You want to be in multiple large skilled labor pools in order to grow quickly. Next slide, please. On the compliance front, this is essentially what you have to look forward to in terms of compliance. What we as a servicer do, it has many different components to compliance, but I won't talk so much about the components of the program as the pressures from outside. As a servicer, it often feels like you're regulated by nobody, but as a result, you're regulated by everybody. I often hear our friends from the UK complain about their regulatory body, but of course when I point out that they're lucky to have only one, there's no comeback. But in the United States, there are many, many regulatory bodies that impact servicing. And there are many layers of rules, and those rules don't always correlate with one another. Often there's no safe harbor, and a choice needs to be made about doing A or doing B, and A or B both have advantages and disadvantages, both in terms of compliance and in terms of effectiveness. It's a very complicated regulatory environment, and unless you're willing to wade into it at a full strength, it is something that is definitely a watch out. So with that note about compliance, I am going to hand it back to Larry for Q&A.
And thanks, David, and thank you for the insight on that. We did receive a whole bunch of questions, and I don't know if we're going to get through all of them, but I think we should be able to get through a few. If there's additional questions, please send them in, and again, we will answer them and send them back out. And so the first question that came in is, why would a company consider to outsource rather than insource or do it themselves?
Well, I'll answer that in two parts. One is we have seen outsourcing as a trend in business across all businesses for the last 50 years. It's one of the biggest trends in the business world. It's a key investment strategy for many of the large private equity funds. You know, we all saw it happen, maybe not all of us, maybe I'm dating myself, in the computer industry, where essentially the industry went from a series of large vertically integrated silos like IBM to a whole host of outsourced horizontal companies like Intel and Microsoft. And that is what's happening in the financial world right now. The large integrated silos of the banks are being broken down into their horizontal components of the value chain, and that's a form of outsourcing. So I would say that's answer one. That's kind of the trend answer. There's a lot of advantages to that in that you get best practice with horizontal value chain players. You get ahead of the curve on many of the issues that normally you wouldn't just be scaled to do because you're not thinking about servicing all the time. And it's generally more cost effective, and it's usually just generally more effective. So the other thing I would bring up on that is that we see a number of insourcers who on the compliance side, they basically devolve to the lowest level of compliance. And what that means is you see companies who are literally, what they'll do is they'll just have people manually dialing out to consumers. No text, no email, just basically trying to crawl back into their shell so that they don't trigger any compliance issues, which is absolutely a valid way to do that. You can do that. The problem with that is portfolio performance suffers. It's not an effective way to service a portfolio. So unless you're really willing to step up and engage with servicing, as a real business, it's very difficult to be effective as an insourcer.
Okay, thanks for that. It's interesting commentary because we see this over and over where most smaller entrants into the marketplace lending space decides to try it themselves. They fail miserably. The portfolio performance is awful, and I would say the majority are not compliant, nor do they have the expertise or the resources to understand what the state-specific compliances are. And here's another question that I received here. What changes do you see for loan servicing the second half of 2016 going into 2017?
Well, I think we're at a really exciting time for FinTech and for loan servicing. Certainly in FinTech as a whole, I'm sure most of the people on this webinar have seen this. There are a number of large securitization deals on the doorstep of getting done right now. And that period of time that we've been going through from roughly February, March-ish to certainly starting in May with a more wholesale pullback is now easing up, and we're seeing money come back into the market on more attractive terms. And I think that's great. So certainly liquidity is coming back into the marketplace. For loan servicers, the dynamic is it's very akin to, in many ways, the community banks, where the cost of compliance continues to increase. So unless you are a scale player, it becomes increasingly more difficult and increasingly less economical to do it yourself or to be a third-party loan servicer. And that's true of the technology as well. It is very difficult to encompass all of the capabilities that are out there that are available for this type of activity without being a scale player in the servicing industry. And we see more and more companies who are, companies that you would think would be, for a FinTech startup, they become scale companies, and they may have 10, 20, 30,000 loans on the books, which is, not huge, but it's in that area where they start to think about what they want to be when they grow up. We see more and more of those companies, in particular, outsourcing their loan servicing. We certainly see that the large new entrants that are coming into the market are starting out with third-party loan servicers from the get-go, from the start. Go ahead, Larry.
And so I was going to keep this to a quick 20 minutes, but we actually just received a whole bunch of really good questions. So let's just take another minute or two and see if we can answer these quickly. Here's a question from George Klinke, friends and clients of First Associates. And George says this seems like it would be applicable to any financial servicing and just not FinTech, correct?
Hi, George. I'm glad you're out there. And George, I saw your 2 minutes with Larry on Twitter just the other day. And, that is correct. And although we talk about FinTech quite a bit, we have many clients, and I saw several of them on this webinar list, where you would look at them and you'd say, oh, that's an old school, financial company. But when you lift up the hood, what you see is more and more of these companies have constructed a value chain that is essentially FinTech. There's a bank charter at the beginning. There's a third-party origination platform. There's a third-party servicer and custodian. There's the company itself. And then on the back end, there's a set of funds that are often, buying the loans, or they're helping the company warehouse the loans, and then eventually they're taking them out to securitization. The value chain looks the same as what we would normally call as a FinTech company. So absolutely applicable and absolutely part of the evolution or revolution that we see in the consumer financial space.
And here is the last question we're going to answer today. We do have a bunch of others that we'll answer and send back out, and this is really good. And we hear this a lot out in the market. And the question is, as First Associates has been the leader in e-communications, are these outcomes as successful as just phone calls?
You know, the main thing about communicating with a client is that, or borrower, I should say, is that you need to communicate with the borrower. And we have found time after time that communicating with the borrower in the way that they want to be communicated to is key to making the portfolio perform. You know, just as a philosophical issue, every borrower who is delinquent probably has 7 bills that they need to pay and only has money for 4. And we very much view our job as selling ourselves into the top 4. It's a sales job. And being a sales job, you want to deal with that borrower in a way they like, right? And it's the same on customer service. If you're forcing the consumer to deal with you in a channel that's not their preference, you're just not going to be as successful. And more consumers prefer to deal on a non-voice level. And for those that do prefer voice, there are, you know, multiple ways of dealing with voice that make it a more effective, more convenient for the consumer, and just a better outcome for everybody. So, you know, is it as effective as a plain old phone call? It's much, much more effective to be what I would call omni-channel than kind of single-channel phone call. And I'll also just throw in that it also makes it much more relevant to the regulatory environment to make sure that what you're doing is compliant with regulations. It really makes that work much better when you have more availability and more choice in your communications channels.
And thanks. And thank you, everybody, for taking the time today to dial into our webinar. As a reminder, yes, we will be sending out the deck and answering any additional questions that continue to come in. We look forward to seeing you again on the next webinar on September 21st, and also at our Southern California Consumer Finance Professionals Meetup on September 21st in Carlsbad. Have a great day, and look forward to seeing everybody soon. Thank you.
Thanks, everybody.